Benjamin Franklin famously said, "Rather go to bed without dinner than to rise in debt." That simple concept of financial responsibility helped shape the economic mindset of the early United States. But fast forward to 2024, the US government has accumulated over $35.5 trillion in debt. By the end of the first half of 2025, that number hit 37 trillion, a figure that is so large that it's impossible to understand. Here is some perspective. If you save $1 million every single day, it will take you 100,000 years to reach 37 trillion. Meanwhile, the US produced about 29.2 trillion GDP in 2024. With a national debt of 35.5 trillion, the US debt to GDP ratio reached 122% by the end of 2024, highest debt to GDP level since World War II. Even worse, Trump-era tax cuts are projected to add another $3 trillion to the national debt. And not surprisingly, Moody's Ratings, a major credit rating agency, has downgraded the US credit rating from AAA to AA1. This leaves us with some serious questions. 1. How bad is the current debt situation in the US? 2. Why do investors around the world still lend to Uncle Sam? 3. What does the future look like? To understand the US debt, we first need to understand how government borrowing works. When the federal government spends more money than it collects in taxes, say on things like roads, defense, or healthcare, it runs on a budget deficit. To cover that gap, it borrows money by selling things like treasury bonds and bills to investors. Over time, these yearly deficits add up. The national debt is the total amount the government owes from all that borrowing plus the interest it has to pay on it. It's kind of like using a credit card. Each time the government spends more than it earns, it adds to the balance. And if it doesn't pay off, the debt keeps growing. As of the end of 2024, the US federal government owed $35.5 trillion in total debt. Roughly 28.3 trillion of that is held by the public, investors, foreign governments, and the Federal Reserve. The remaining 7.2 trillion is intragovernmental debt, money owed to programs like Social Security and Medicare, which invest surplus funds in treasury bonds. In fiscal year 2024, the government spent a record $900 billion on interest payments alone. That's more than what was spent on Medicare or national defense, and nearly equal to the entire GDP of countries like the Netherlands or Saudi Arabia. Despite solid economic growth and no major war, this deficit continues to grow, reaching $1.8 trillion in fiscal year 2024, up from $1 trillion the year before. According to Congressional Budget Office, debt held by the public will rise from 98% of GDP in 2024 to nearly 180 by 2053. We will talk about this later during the video. So where did the US government spend all this money? In fiscal year 2024, the US government reported gross cost of $7.77 trillion. The official budget deficit, the gap between revenue and spending, was $1.83 trillion, up from $1.70 trillion in 2023. Most of this spending went towards a few major programs, such as healthcare, social security, net interest payments, and national defense. If you only look at the government spending categories, the US government is essentially an insurance company with an army. All this points to one conclusion. The US debt situation isn't just a future problem, it's already a serious and growing challenge. But despite all this, investors around the world keep lining up to lend US government money. Why is this the case? In short, the US treasuries are a cornerstone of institutional portfolios because they are viewed as safe, liquid, and dependable. Foreign investors, both governments and private entities, hold about $8.5 trillion in US debt, roughly 30% of debt held by public. In 1970, this figure was just 5%, highlighting how global demand has risen over the decades. Investors from China and Japan hold a combined $1.8 trillion, although both countries have reduced their exposure over the past decade. At the same time, other nations, including the UK, have increased their holdings in the same period. There are several reasons why US Treasuries remain attractive globally. First, the US dollar is still the dominant global reserve currency, which creates sustained demand for dollar-denominated assets. The US bond market is also the largest and most liquid in the world, making it easy to trade treasuries even during times of economic uncertainty. Moreover, the US has a large and relatively resilient economy, a long track record of honoring its obligations, and a legal and political system that still commands global trust. Compared to other major economies, the US remains a more attractive option. China has capital controls and political risks. The Eurozone lacks of physical unity, and Japan faces long-term stagnation. As a result, there is currently no viable alternative that matches the scale, depth, and perceived safety of US debt markets. Additionally, central banks, sovereign wealth funds, pension funds, and insurance companies require long-duration, low-risk assets. US Treasuries are the global benchmark for that purpose. However, foreign ownership also comes with trade-offs. Interest payments flow out of the US economy and into the hands of overseas creditors. It also introduces a degree of external influence over American financial markets. Over time, rising debt and reliance on foreign capital could create vulnerability, especially if global confidence in the US fiscal policy starts to erode. Warren Buffett acknowledged that because the US borrows in its own currency, it can never technically default in the traditional sense. However, he warns that printing money to cover deficits can lead to a serious inflation and erode confidence over time. He has noted that rising interest payments on debt could eventually make the situation dangerous. As debt grows and rates rise, more tax revenue is consumed by interest payment, crowding out spending on other priorities. So, if things continue to unfold similarly to the past few decades, what would the future look like? At the end of 2024, US public debt stood at 98% of GDP. According to the Congressional Budget Office, this figure is projected to rise to nearly 180% by 2053. The primary drivers include persistent budget deficits, which are expected to average 5 to 7% of GDP annually over the next decade. Interest costs are accelerating rapidly. By 2026, they are projected to reach 3.2% of GDP, surpassing the previous peak set in 1991. By the year 2035, interest payments alone would consume 4.1% of US GDP. That means nearly 4% of the nation's entire economic output will be devoted solely to servicing existing debt. If current trends continue, total federal debt could grow to 5 times the size of the economy by the year 2100. Meanwhile, major entitlement programs like Social Security and Medicare face funding shortfalls within the next 10 years. Demographic pressures from an aging population, fast-growing healthcare costs, and the gradual normalization of interest rates are expected to push the debt and deficit levels even higher. Rising global tensions and expanding military commitments add yet another layer of physical pressure for the US. The US consistently spends far more on defense than any other country, largely because of its unique global role. As the backbone of alliances like the NATO and the only nation maintaining hundreds of military bases around the world, the US shoulders immense security responsibilities. These commitments translate into sustained and growing military costs. For now, printing money has helped cover the gap between spending and revenue. But while this may work in the short run, it's not a sustainable long-term strategy. The risk is clear. At some point, foreign governments and investors could lose confidence in America's ability and willingness to manage its finances responsibly. What once seemed like a distant scenario is starting to feel more plausible, especially after the recent US credit downgrade by Moody's and continued political instability in Washington. Meanwhile, the government itself is divided on how to move forward. Some lawmakers are trying to reduce fiscal deficits by cutting programs like Medicaid, despite warnings about the rise in uninsured Americans and the long-term health consequences. Others are moving in the opposite direction, supporting tax cut measures like the Big Beautiful Bill. While the current administration claimed that tariff revenues will help offset the increased spending, early projections show a significant rise in both deficits and overall debt over the next few years due to the introduction of Big Beautiful Bill. There is still uncertainty around how this will all play out, but one thing is becoming increasingly clear. If Washington continues to ignore fiscal discipline, relies on debt finance spending, and turns to the money printing press to manage repayments, there will be consequences, severe consequences. The day investors stop trusting the US to manage its debt could come faster than most expected. And if that happens, history shows us what often follows. Because more often than not, great powers don't fall from external threats, they usually collapse from within.